All right, let's get right into it. Today, we are tackling one of the most powerful and, honestly, most misunderstood tools every single trader needs, the stop-loss order. This is the thing that takes you from trading with your gut and your fear to trading with cold, hard discipline.
You know the feeling, right? We've all been there. You're in a trade, it goes a little bit red, and you tell yourself, oh, it'll come back. But then it doesn't. And before you know it, what should have been a tiny, manageable loss has just blown a hole in your account. That pain is exactly why we're talking about this today.
And make no mistake, the stakes are unbelievably high. As the source material says, traders who just kind of guess where to put their stops, using random numbers that feel good, the market will eat them alive. It's an unforgiving place, and it will sniff out those weak spots.
So how do we protect ourselves? Not just from the market, but from our own worst instincts. Well, we build a financial safety net. Let's break down exactly what that looks like.
At its most basic level, a stop loss is just an instruction. You tell your broker ahead of time, hey, if this trade goes south and hits this specific price, get me out. No questions asked. That's it. It's your automatic, pre-planned eject button.
And this is a huge mindset shift. So many traders obsess about the perfect entry, but the pros? They are just as obsessed, maybe even more so, with their exit. A stop loss isn't about making a profit. It's a purely defensive move designed to do one thing and one thing only: protect your money.
And this is where it becomes your psychological shield. Think about it. By setting a stop before you even enter the trade, you're making a rational decision when you're calm. You take that emotional, in-the-moment panic completely out of the equation. It forces you to be disciplined. It means you don't have to stare at the screen all day. And best of all, you know exactly what your maximum risk is from the get-go. That is peace of mind.
Okay, so you're sold on the why, but it's not quite that simple, because not all stops are built the same. You've got different types, and picking the right tool for the job is a massive part of the strategy.
So here's the classic dilemma. A standard stop order, sometimes called a stop market, guarantees you get out. Once your price is hit, it triggers a market order and sells at whatever the next available price is. The downside: if the market is crashing, that price could be way worse than you planned for. That's slippage. On the other hand, a stop limit order guarantees your price. It will only sell at your chosen price or better. The risk: if the market gaps right past your price, your order might never fill, and you're stuck in a trade that's getting worse. So the question is, do you want a guaranteed exit or a guaranteed price?
Now for the fun one, the trailing stop. This is less about defense and more about smart offense. Instead of just sitting there, this stop automatically moves up as your trade moves into profit. It trails behind the price, but the moment the price turns around and starts to fall, the stop locks in place. This way, it lets your winners run, but automatically protects a big chunk of your profits if the trend reverses. It's brilliant. All right, we've covered the what. Now it's time for the where. And let me tell you, this is the part that separates the amateurs who get chopped up by the market from the professionals who last for years. This is not about guessing. It is pure strategy.
The single biggest mistake traders make is picking a stop based on a random number. You know, I'll risk $100, or putting the stop at a nice clean number like $50. The market has no idea that number exists. It couldn't care less. And those arbitrary levels are often just sitting right in the middle of normal market noise. So you get stopped out of a great trade for no good reason.
Now, here's the big reveal. Professionals do this completely backward from how amateurs think. They don't start by saying, how much should I buy? They start by looking at the chart and asking, where is the logical place for this trade to be wrong? They use the market's own volatility to decide on a stop distance. And only then, only after they know their exit, do they calculate how much they can buy. The market tells you where the stop goes. The stop tells you your position size. It's a total game changer.
So where are these logical places? Well, you let the chart tell you. You look for major support or resistance levels and place your stop just on the other side. You can use big, important moving averages as a dynamic line in the sand. Or, even better, you look for confluence, a spot on the chart where multiple technical reasons all line up screaming that this is a critical level.
So you've got the placement down. Now it's time to level up. Let's get into some of the more advanced tactics and the traps that really separate the consistently profitable traders from everyone else.
This is a big one. You always hear, set it and forget it. And that is great advice for one thing: never moving your stop further away just because the trade is going against you. That is a recipe for disaster. But you should absolutely manage your stop to your advantage. Once the trade moves nicely in your favor, move that stop up to your entry price. Boom, you now have a risk-free trade. That's not breaking the rules. That's intelligent risk management.
Now, for a topic that sounds like a conspiracy theory, but it's real. Have you ever had that feeling where the price comes down, taps your stop perfectly, and then immediately reverses and goes in the direction you wanted? Yeah, you're not crazy. That's called stop hunting.
So how do you defend against it? Simple. You stop being so predictable. Stop putting your orders on those obvious, clean, round numbers. Give your trade a little extra breathing room beyond the key level. Some very disciplined traders even use mental stops, which aren't on the broker's books at all. And of course, trading when the market is most active and liquid makes it a lot harder for anyone to push the price around.
And one final, super important dose of reality. A stop loss is an order, a trigger. It is not a guarantee of a price. In a crazy fast market, or if a stock gaps open overnight, the price you actually get out at could be way different than where your stop was. It's a fantastic tool, but it's not magic. You have to understand its limits.
Okay, let's pull all these pieces together. Let's create a clear, simple framework for how you can use stop losses like an expert to truly control your risk in the market.
It really all comes down to these 3 pillars. Number 1 is discipline. Setting a stop every single time and actually honoring it, no excuses. Number 2 is adaptation, knowing that a volatile market needs a wider stop than a quiet one. And number 3 is proactive mitigation, being smart enough to avoid obvious stop levels and understanding how the market works.
And this is the core idea, the most important takeaway of all. Trading is a game of statistics. You are going to have losses. The goal is not to eliminate them. The goal of a pro is to make absolutely sure that every single loss is a small, controlled, insignificant event that never ever threatens their ability to keep trading. Your stop loss is what makes that possible.
So I'll leave you with this to think about. When you put on a trade, is it built on a foundation of just hoping it works out? Or is it protected by a fortress of discipline, with your stop loss standing guard at the gate? The answer to that really will define your entire trading journey.
Hey, I really hope this deep dive into the stop loss was helpful for you. If you got some value out of it and you want to master more of these core trading concepts, please hit that like button and subscribe for the next one. Thanks for watching.